Okay. Good morning, everybody. Thank you very much for joining this call today. Our Business Voice webinar series continues. This is one of three webinars that we have following the business survey that we conducted in June 2021. The Irish Business Voice survey was conducted with the Chambers of Commerce around the country, and we had 264 respondents to the survey. Hopefully, most of you will have had access to those survey results. Part of the follow-up of these three webinars is to drill into some of the issues arising from the survey, and to provide some high level guidance in terms of addressing the issues arising from the survey. So, in terms of an introduction today and our agenda today, I'll just give a very short overview of the survey results at a very high level, and then we'll focus on three areas of concern arising from the survey. Dara Kelly is a partner of mine in corporate finance. He will look at fundraising issues and access to funding. My partner in tax will look at tax issues surrounding the survey, particularly the new Revenue Audit Code of Practice, which was released 1st of May which will be released 1st of May of this year, and topical issues that Vic is seeing in interactions with revenue and SMEs. I'll round up the morning with a piece on restructuring. One of the largest issues arising out of the survey was the recovery from the impact of COVID-19. So, sometimes part of the recovery involves restructuring, dealing with creditors, and I suppose I'll deal with possibly the hard or more contentious part of dealing with creditors, again at a very high level. This session is an hour long. The idea is to have kind of 15 minutes for each section, so really a very high level approach, but to allow time for questions and answers at the end of the session. So in terms of the Business Voice program and the results that came out, as mentioned, we 264 responses from the survey, which is undertaken in June 2021. Now, some time has passed since that survey, but bear in mind that the snapshot in time, COVID had kicked off in March 2020, so we were over a year into the COVID pandemic at the time. Lockdown was in place. Lockdown would continue for a while longer. Indeed, it's only recently that we have come out of those restrictions, and the idea was to get responses from businesses that were members of Chambers of Commerce around the country, and to capture the challenges that those businesses had at that snapshot in time. And of course, today is part of Grant Thornton's response to support those members. There were 12 questions in the survey, and the business profile of the respondents is outlined on the following page. So, in terms of the background, 61% of respondents were family owned. Okay, so this, we think this is very reflective of the setup of Irish business being two-thirds family owned. So some kind of a family interaction with siblings, with parents or the like. You can also see from the far right of the page, particularly towards the bottom, the professional services and financial services dominate, professional services 17%, financial services at 9%. So you're talking a good 26% of respondents indicated that they were active in that space, followed by retail and consumer goods, and we think retail dominates that space. So you've a very large cohort there, in around the 35% mark, who indicate that they are primarily services, customer facing, professional services, and retail. The middle spread then of sectors includes more traditional service lines like manufacturing, but also technology, healthcare, education services that are very prevalent. And construction, I suppose that probably varies over time. Construction at 5% of businesses 10-15 years ago, construction might have had a much bigger place in the market, but we think that's realistic and reflective of the overall market. So if I'm able to move on. So in terms of an overview of the survey findings, we drilled down on a few interesting points. In terms of startup businesses, we found that nearly 100% of these startups had turnover of less than 500,000 and with fewer than 25 employees, and an even greater representation being family owned. Overall in the survey, 66% of respondents indicated that they have fewer than 25 employees, okay, and 40% have turnover of less than 500,000. And it's clear that businesses that are over 30 years, so a long time in business, as you might expect, have a much greater turnover and a much greater number of employees. So 54% of respondents who were in business over 30 years had more than 100 employees. So I guess time is a good facilitator of growth, and time is a good facilitator of adding employees and becoming more robust over the years. So just to look at the pie charts below, and to reiterate, 40% of respondents indicated that they had an annual turnover of under 500,000. Okay, and in terms of the 30-year piece, we've 25% of respondents who've been in business for a number of years. So, and not dissimilar to the size of the startup. So there's a really healthy balance there between older businesses and newer businesses coming in. So would suggest, a nice mix. I can move on to the, sorry, I would say around the bottom right hand corners in terms of the stage of the business life cycle, one part that stood out to me was the expanding piece or growing revenue piece, which is around 40% of respondents in June. So whether that's aspirational or whether they were actively growing in the middle of a pandemic, I'm unclear, but certainly it's a feature of an ambitious and a forward-looking business community. So this is the slide that I really wanted to focus on, because essentially what we're doing here is we're taking the areas of concern from the business survey, and we are seeking to address it by bringing in subject matter experts from Grant Thornton to drill down in certain areas. So the responses run through a number of concerns, from implementing and managing sustainable development goals at the top of the page. And what you have to do here is you have to look at the green, orange and blue parts to show the areas that are of concern, very concerned and seriously concerned. So where green encroaches further to the left is areas of most concern. So managing sustainable development goals, interestingly, was cited as of concern. Perhaps respondents are indicating that that they feel a bit lost in terms of reaching development goals. And dependence on COVID-19 supports, interestingly, was some of the lower concerns in terms of dependence going forward. Perhaps that was a point in time, just a year after the introduction of COVID-19 supports, and maybe business felt that their businesses would bounce back quite strongly post pandemic. Perhaps they didn't realize that the supports would be necessary for so long, or that there would be interesting changes in the market. But certainly what we're experiencing with our client base now is perhaps the weaning off supports is a real challenge. So an interesting result there. Other ones: supply chain complexity, organizational structure, business process efficiencies. We had a series of 3 events. Our second event included business process efficiencies, where our business consulting division addressed some of the issues there. And we find business process efficiencies are up there as a key area of concern for the respondents here. And perhaps this is down to supply chain innovation, digital and IT, the movement forward of businesses and being able to keep up with the demands of the market. Possibly an overlap on the innovation side. Vic will talk to tax compliance and regulatory requirements as indicated. We're quite confused by the results here, indicating some of the lowest results for concerned, very concerned, or seriously concerned by respondents. Without indicating that there's a contradiction here. This could be a moment in time, June 2021, where indeed there had been no revenue interventions in the form of enforcement for over a year at this stage. In fact, the focus really from revenue had seemed to shift to the various supports, and enforcement what was not happening. So perhaps there's a bit of complacency perhaps featuring here. And I wonder if we took the survey later on this year, would that sentiment change? Vic certainly agrees with that, and we'll be addressing some of the issues as indicated. The biggest area of concern was upskilling, retention of current workforce, and access to a skilled workforce. And my colleague Anne Phillipson, Director in People and Change Consulting, drilled into this issue in the last session. And we know that matters haven't changed with our client base at the moment. Access to workforce is a key concern. And digital transformation, automation required. We know there's been a big scaling up in terms of the move to IT, the move to platforms on the internet for markets to access products and services. And we know this sped up during COVID-19, so no surprise there in terms of the levels of concern that the respondents have. Managing a multi-located workforce now in post-COVID-19. I suppose in June 2021, respondents really getting their head around the mobility issue, and maybe some respondents ahead on the curve, others behind, some more concerned, some less concerned. But I think if that response was taken today, I think there might be a change maybe to sentiment, or certainly be interesting to see any changes there in managing a multi-located workforce. Brexit featured, but possibly not as strongly as we indicated. And one of the strongest or biggest areas of concern was the area of the recovery from the impact of COVID-19. So, really across the board in terms of changing habits of customers, impact of supply lines, and the changing structure of the market with the drop in turnover, all during the COVID-19 period. So that was a real concern in June 2021, and I think that concern still remains. As mentioned, Dara will look at managing and maintaining cash flows access to finance, which were both key areas of concern at the time of the survey in 2021. So in that respect, what I'll allow is Dara to talk to his piece now, and if we can focus on those two last areas of concern, Dara will seek to address those now. Thanks, Dara.
Thanks, Angus. Good morning, everybody. My name's Dara Kelly. I'm a partner in the corporate finance team in Grant Thornton, and I'm going to just do a piece on fundraising in the current environment, and just, you know, key to fundraising is the cash management of the business and how you present that to a lender. So a lot of our clients now are assessing, our SME clients are assessing their funding requirement coming out of hopefully getting out of this, you know, COVID-19 environment, but also coming out of the funding supports that were made available by the government. And, you know, what I would say initially is we've never had a greater choice of lender. We've got on the bank front and the non-bank front, so that's a real positive. It's about matching the lending ask or the borrower with the right lender. But it's very positive to have that choice. But hand in hand, key to looking for fundraising, and let's just talk to debt fundraising, is we need to be able to show, you know, debt repayment capacity, and we need to show control over our own cash flows. And, like, you know, it's the number one failing on funding applications is not given enough thought to, and given the lender comfort of your ability, or the SME's ability to match the debt repayments. So just to talk about the kind of, I'm going to touch on a couple of points here. So, and this is in the context of fundraising, right? So one of the supports that was pushed very hard during COVID-19 was by Enterprise Ireland, and it was called a financial planning grant. And essentially it's a 5,000 budget to retain financial advisor / accountant to prepare what started off as a 3-year plan, became a 5-year plan, set of financial projections out over 5 years, but proper integrated P&L, balance sheet, cash flow, together with a very high level business plan Word document. And the idea of it initially was to allow EI clients to access an EI sustaining business fund. But the great byproduct of it was that it essentially allowed SMEs create a business plan at minimal cost, right, and potentially kept it under the 5,000 euro support that they could then bring to a lender. We'll talk about this. Is still available as a support. We would just recommend this as a no-brainer to anyone that can access it. It's you know, it's a $5,000 free budget to get support. Especially if you're in an SME, if you don't have a very big finance function, and majority don't, this is something that you can get help with, instead of, you know, having the time burden and potentially a gap in experience in how to prepare these. And the output then can be used to access funding. So that's kind of, if like we did over 100 of these between 2020 and 2021. And it's still being, we're still getting a couple of requests on it. So it's still there. And in the context of accessing funding, something that needs to be looked at. I'll touch on the credit guarantee scheme. They're talking about a closing date of June, but I'd say it'd be extended. And then on the smaller debts, bite-sized, the smaller funding packages are still available through microfinance. The non-bank lenders, like there's a huge amount of options on this front, and they just by matter of fact are more flexible and have less conditions in their loan facilities. They might not always be the lowest interest rate, but they're genuine now contenders when SMEs are looking for funding. And then you've got the pillars, which is AIB, Bank of Ireland, and Permanent TSB have put a real push into SME lending over the last year or so. We now see them as a genuine option of the 3 pillar banks. when we're going out for funding for that senior debt. So if I go and just quickly touch on the financial planning grant, as I said, it's 5,000 budget, easy enough to access. You actually end up with a pre, it's a template output that you must produce. We as the financial advisor on the assignment have to produce an output, but we actually built something that sits behind that, so that we can tailor the output depending on what lender we're going to, but also it ticks the box for EI so that they will in turn fund the grant to the SME. So it kind of works best of both ways, but we're just getting a bit more out of the workflow. So again, I just think from a proactive perspective, if it's available to you and you haven't gone through the process, it's not at any cost, a little bit of time, but really it's been used across the board, very heavily used over the last couple of years. The next then is the credit guarantee scheme. So this really sits well where an SME might be struggling to, to give the collateral that the main lenders would need for the type of credit risk they perceive. So it's essentially an 80% guarantee to the lender, right? There's more than, well, obviously UB are out now, and there is actually a whole list, including credit unions on it now. It's all on the website. So the facilities are up to $1 million, and there is an element for the unsecured as well, which really gives a lot of flexibility on those couple of 100,000 loan applications. The interest rates are going to be pretty good. They obviously vary per lender, and the terms up to 5.5 years. It's something definitely to be looked at, like where we are seeing a bit of flexibility with the main pillar banks here is that we will submit a loan application, but they might split it into two, that they will go down the credit guarantee scheme for a portion of the loan, and then through their main normal credit procedures for the other portion. So we're seeing some flexibility there, which is good. There's all of this is on the websites, but it really is fairly broad. It will cover working capital, but it'll also cover capital, like capex. So it's quite an element of flexibility into it, and obviously it can be used for refinancing, exiting lenders, and also can be used to essentially term out the buildup of COVID-related expenses. So if you'd built up a very common one is a business with an overdraft, and that's now become a hard overdraft. Like, so if it's a 500K overdraft, it's always in the overdraft. So it's essentially might as well be a loan. And this is an option now that the interest rate on that overdraft might be great. So you can term it out, turn it into a 3-year loan, for instance, at a lower interest rate, and allow the business just to get out from under essentially what's become a hardcore overdraft. I've included microfinance. It allows for loans up to 50,000, and you can apply through the website. You obviously don't need an accountant to do this, but it's something for the smaller SMEs definitely to consider. The interest rates, I think they're the max interest rates that are quoted on this deck. You could get lower. And again, I think you have more success going through your local enterprise office when trying to assess this finance, but it's there, and it's a genuine loan opportunity for the smaller SMEs. So the next slide is so the reason I've added this in is, again, go back to the point. There's lots of opportunities for debt finance. We're not going to touch today on the other opportunities, which is taking in minority shareholders or taking in majority shareholders. That's I suppose a different presentation. But on the basis, there's lots of lenders. You just need to match You need to match your requirements to the right lenders. Like there's a lot of lease finance there. There's a lot of invoice discounting there with non-bank lenders, plenty of opportunity there. But it will all come back to, the question will come back is, okay, well, show us your projections, show us how you're going to pay us back. And we do spend a lot of time on this, which is cash management. And there's kind of 7 drivers for cash management in a business, and how to generate how to do more cash conversion. The obvious ones are debtor days, your stock days, creditor days. Then it comes into your pricing. Can you push up your pricing per your product? Obviously, revenue growth is more customers. But looking at your cost of sales, direct cost of sales, is there anything you can do with your suppliers? And then obviously always keeping an eye on overheads. And the last one then is capital expenditure. So should we be lease financing? Should we be straight out purchasing our equipment? And in these columns here, and I have some more slides in the appendix, are just little points to consider. Like there can be little things to do around credit terms on both your supply side and your sales side that could make big difference to your cash conversion. And the bottom line of all of this exercise, which really finance function should be building in as at least a monthly exercise, is that you're trying to give comfort that you can convert your business's activity into cash flows which will service the debt, and that's the whole debt repayment capacity. That's the comfort that you're trying to give on the loan application. So really, our message would be great time to great range of lenders, but it's still the same principles. It'll all be about showing your debt repayment capacity, and always do a couple of scenarios, at least 2. Do your base case, and bear in mind that lenders will always stress test the base case. So they will just come up with theoretical scenarios where you don't do exactly what your projections say, because projections, to be fair, 1 year out is reasonable, 2 years out, it's really, the actuals will always be different, and lenders will be looking for downside protection. So I won't go through the appendices just with the time we have today, but that's just that's, I suppose, an overview of SMEs and accessing the debt funding market currently. I can take any questions at the end, so I'll pass over to Vic.
Thanks very much, Dara. So as Ingus mentioned, folks, sorry, we'll just move to my set of slides.
Vic, just before you do, I'd just like to remind those on the call that questions can be put through the chat function, and we will leave questions to the end if that's okay. There'll be a bit of time at the end. Thanks.
Good stuff. Thanks, Angus. So as Angus mentioned at the outset, folks, new code of practice for revenue interventions or compliance interventions by revenue kicks in with effect from 1 May 2022. It was published in mid-February after having been muted that it would be launched in Q3 of last year. So a little bit of a delay on that. But thankfully, not many significant changes, but there are 1 or 2 important ones. So in essence, what we have is we have a code of practice, but behind that will be, or what's going to drive that, is a compliance intervention framework, as Revenue have termed it. So it's basically broken down into 3 levels with a specific objective under each. So level 1 being to support compliance, level 2, challenge non-compliance, and level 3 to tackle high-risk cases. And we'll talk about each of those in a moment. In terms of the objective, I know from the attendee list that I've spoken to a number of you individually, and some of you might have participated in other webinars for an accountancy body that we've made this presentation to recently. And prior to that, last year, we would have referenced the 2021 to 2023 statement of strategy by Revenue. This is very much in line with that. There's very much a carrot and stick type approach to the language within it. They talk about robust interventions, robust responses to non-compliance. And really what they are very much trying to do is drive a culture of self-review. We'll break that down a little bit in terms of what that looks like under level 1 interventions in a moment. If you were to drop off this call right now as an advisor or as a taxpayer and take nothing else from it, this would be the key point. What were previously aspect queries are now on all fours with a revenue audit. They've been rebranded essentially as a risk review. So an aspect query, you know, you would be aware, you know, you typically wouldn't have too harsh an outcome if you respond appropriately. Now you're on a level 2 interventions, which is in the prompted qualifying disclosure space, and is one where you cannot therefore avail a non-qualifying disclosure, minimize penalties or mitigated penalties. As I mentioned, kicking off from 1 May 2022, the question that has come up from a number of clients in terms of existing audits is, well, what does that mean for my ongoing interaction? Anything that commences or notification is received in respect of prior to 1 May still sits under the old code. So what are the key changes in the 2022 code versus 2021? Well, most of them are helpful. The first being that notice of intervention, that timeline, there's been an increase of 1 week. So whereas previously, you know, the notice period was 21 days, that's now been increased to 28 days for a level 2 intervention. It's been increased from 14 days to 21 days for those who wish to get the 60-day extension by virtue of the fact that they're making a disclosure. The types of interventions, key changes are that a lot of the old non-audit interventions have been removed from the code, so no assurance checks, sector reviews, JIUs, and so forth. And as I'd mentioned, aspect queries now cease, albeit, you know, the type of interaction that you will have with revenue in the form of now what will be revenue audit, or revenue risk reviews, my apologies, will still take place. Another helpful change is that the publication threshold will increase from €35,000 to €50,000. Important distinction being that €35,000, many of you may be aware, was tax, interest and penalties. Now it's just the tax amount, but what will be published will still be the tax, interest and penalties. And we ran a little bit of a review of the last 2 years' publications. And interestingly, of the published cases over the last 2 years in the defaulters list, actually half of those wouldn't be published under the new code of practice. As I mentioned, no option to make an unprompted disclosure for level 2 interactions. And you can, interestingly, now this has come through in the code of practice, but is actually in effect since 1 January because it was pushed through in Finance Act 2021. You can now make disclosures in relation to offshore affairs. I think it was 107.7E precluded you from doing that previously. Now you can actually get mitigated penalties in relation to offshore matters. Penalty levels are more penal for risk reviews, as we've mentioned. And the key point then is the code of practice covers all tax heads with the exceptions of customs, which are now covered by EU customs code and EU legislation. So breaking down the levels themselves. So what is level 1? Level 1 is the carrot. It's supporting compliance. The language used by revenue is very much, we are trying to foster and facilitate a culture of self-review. In terms of the activity, you will get correspondence from revenue suggesting that you undertake a self-review. If you get that, that is not a revenue intervention where you cannot make an unprompted disclosure. And we've had a number of those, particularly coming out of high net wealth individuals division over the last couple of months. Profile interviews, bulk non-filer reminders, and CCF engagements for anyone on the line who is in LCD. So that's Cooperative Compliance Framework. The disclosure position, as we mentioned, is unprompted, and you can make a payment of liability, self-correction, or file an amended return to correct issues that arise there. Level 2 is broken down into 2 broad categories of interaction: risk review, akin to an aspect query, and a full-scale audit. The timelines, as we've mentioned already, 28 days notice. The key point that typically comes up for companies and taxpayers that come to us for support, non-existing clients where we would work with smaller advisors, given our specialism in this area, is the misconception that it's 28 days from the receipt of the letter. It is not. It's the 28 days from the date of the letter, and that can often be quite costly. Corrective actions are really just in and around payment of the liability or filing amended returns. And again, you're in prompted disclosure territory there, whereas previously you would have been unprompted for risk reviews. And I won't say an awful lot other than this is a very, very grave situation to be in if you receive notification of an investigation. Our advice and our position as a firm is, if a notification of level 3 comes out, we do not engage, we do not submit, or would not recommend any advisors to submit any form of disclosure on that. Our advice across the board is engage with a legal professional to support you through a level 3 intervention, because where revenue are essentially driving at with level 3 interventions is criminal prosecution. So at your peril, take on a level 3 intervention for a client if you are an agent. In terms of regularizing those tax defaults, I've just set out at a very high level there. We'll include a little bit more detail in the appendices. So what are the key things that come up on say self-correction without penalty? Well, timing. What's the time frame? So on all taxes, with the exception of VAT and payroll taxes, essentially it's within 12 months of the return having been filed. When it comes to VAT and payroll taxes, it is possible to self-correct without a penalty. Statutory interest will apply in situations where you have VAT and payroll. You can do so by the prior to the filing deadline for the corporate or income tax return of the period within which the VAT issue arose or the payroll tax issue arose. So that's the timing. The other key issue that comes up from some taxpayers in terms of a misconception or misunderstanding is, well, can I just not self-correct by submitting a return? No, a corrected return or amended return does not constitute self-correction from revenue's perspective. It must be in writing. It must set out the changes, the correct tax, the interest that has been applied, as well as the full liability. One important point that's often overlooked is that self-correction in the VAT space can be done in the subsequent period VAT return without notification to revenue, where you are a periodic filer. So everyone bar annual VAT filers who have adjustments to make of less than 6,000, that can be actually done in the subsequent period. Other issues that come up regularly in terms of, misconceptions or misnomers are, when can I use the no loss of revenue card in an interaction with revenue? Revenue have been very clear to say the no loss of revenue will not be permitted where the default is deliberate behavior, an egregious failure as they would regard it. You don't make the claim in writing. The taxpayer hasn't cooperated fully. So, if at the back end, you come across issues and you haven't cooperated throughout the intervention, revenue will not facilitate a no loss of revenue argument. In terms of disclosures, then we've broadly covered the timelines at the outset, so I won't cover that, mindful of time. But the key point is that it must be made in writing, declaring all of the information that's complete and correct. Again, another misconception that's out there is it must be all tax heads and all period. It is not. If the intervention comes in respect of VAT, it relates to VAT in isolation. It must include a payment of the tax duty and interest. It does not have to include the penalty. Our position here is that we would not disclose the penalty. But I do know of some former colleagues in different firms who do that as a stake in the ground on their view. But the technicalities of it are that you do not have to make the penalty payment. And what are the benefits? Well, obviously reduced penalties, non-publication, and revenue will not initiate criminal proceedings where you avail of unprompted or prompted disclosures. The key point being neither of those are options under level 3. So you cannot avoid criminal prosecution in that sense. Very briefly then, in terms of key actions, these slides will go around. I won't spend an awful lot of time. Our strong recommendation to taxpayers is use the intervening period between when the code was launched. So you only have really 5 or 6 weeks now at this point to try and regularize your affairs by way of an extensive review. We have developed a tax control framework in terms of a go-forward situation where you're trying to de-risk and mitigate against any dropped balls, if you want to put it that way. And that's a really, really interesting point, actually. Even the most savvy of financial controllers, if they, for example, missed e-briefs as a kind of a constant thing to watch and make adjustments to their internal processes on the back of, we actually ran an analysis, and there were over 40 adjustments across the previous 2 years e-briefs that could, in theory, if your agent hadn't advised you of that issue and you hadn't been keeping on top of e-briefs, if you were a financial controller, there were 40 different issues that could have resulted in an additional tax liability. Again, this is really, really critical for those on the line who are representing clients. I won't go through it, but I would refer back to it if I were you in terms of the process, your best-in-class process to adopt when a notification is received from revenue around an intervention. And then finally, for me, in terms of key areas of focus, we've set those out. It really does come down to very simple and straightforward stuff often. It can be a systems gap, a process error. What we see in the VAT space is, recovery on disallowable expenses, like, for example, hotels. In some instances, would you believe, often, the reverse charge on intra-community acquisitions will come up. This is really the stuff that is like shooting fish in a barrel for revenue, and that self-accounting piece is missed time and time again. From a non-VAT perspective, it's company loan, it's the director's loans, company cars. We're seeing a lot, actually, interestingly, whether there was a push by the motor industry, a number of interactions from directors, possibly on the back of the changes to the electrical vehicles, looking to, take Land Rover Discoveries and regard them as subject to the 5% BIK as opposed to the 30% BIK. That's come up a fair bit. The one, actually, a chap that I coach rugby with who has a small practice it wasn't aware of this change. So I would urge you, if you haven't come across it, to take a look at the statement of practice issued by Revenue in the summer of last year around single member companies, essentially piercing the corporate veil and looking through the fact that a company might be contracting and regarding that as an employee relationship rather than a self-employed or corporate relationship. So that's pretty much it for me. As I said, there will be appendices that attach this presentation with a little bit more detail on the disclosure provisions. My key piece of advice to you would be mindful of the massive investment that Revenue have made in technology. We are seeing smaller advisors come to us late in the day looking for our support around data interrogation capabilities. It's like bringing a knife to a gunfight if you try and take on Revenue based on their technological capabilities without doing so. So I think either reach out to someone who has that capability or invest a bit of time yourselves in building that equivalent capability in terms of be it an Alteryx or a Caseware software to try and match Revenue's resources. And if there are any questions, as Angus mentioned, happy to take them at the end. I'll hand over to you then, Angus, if that's okay. Thanks.
Thanks very much, Vic. That was really really helpful, really interesting. So look, I wanted to round out the session today on the last of the three kind of drill downs, and just to remind that the topic of the webinar today is around recovery from the impact of COVID-19. So restructuring is certainly an area that we need to look at. I'm focusing today on the insolvency piece, where there is a problem with creditors. Okay, the usual route to dealing business is that you pay all your creditors. Where you have a situation that you've been trading for a period of time, creditors have built up, and you have a real issue there with trading going forward or dealing with historic debts, then there is a toolbox there per the Companies Act that is available. And that toolbox can be initiated by the company. So a kind of a director-led scenario where a company or business may look at liquidation. Examinership is an option for larger businesses. And schemes of arrangement can be both a court process and a non-court process. We would always favour action by directors in terms of tackling the issue themselves rather than waiting for creditors to take action. And the kind of action the creditors can take following judgment against a company or a business for non-payment of debt is a court-appointed liquidation or receivership generally by a charge holder like a bank, somebody who's registered a debenture against the company and has a form of fixed or floating charge security against the company. I suppose the issue with creditor-led insolvency is that really things move out of the hands of the company directors and into hands of the creditors, be it Revenue, be it a trade creditor, or be it some kind of a lender. I also want to touch on personal insolvency solutions. Since 2014, we have a suite of formal personal insolvency solutions that are non-corporate, non-company insolvency solutions dealing with the likes of sole traders, as well as individuals with personal and mortgage debt. But I suppose for the focus of this seminar, which is business people, it's really tailored towards sole traders. And finally, December 7th of last year came into legislation the Small Company Administrative Rescue Process, SCARP. I suppose the criticism of Examinership would have been the costly nature of court applications. So this is an attempt to preserve the company and allow a write-off of debtors as part of a scale-down process, a non-court process, and I'll touch on that also. I suppose, why do I focus on official Companies Act-based formal restructuring? Well, there is, of course, informal restructuring, but I suppose the problem with informal restructuring where creditors are owed monies, particularly where the numbers of creditors increase and are on a sizable list, it's harder to agree creditors to come together in an overall settlement. So it's almost like herding cats or chickens, trying to get the creditors to agree. Creditors will jostle for position. They will put pressure on companies to get paid first, whereas the quieter creditors perhaps might be pushed out on the back finger and might not be paid at all. So to avoid this kind of law of the jungle scenario where some creditors are heaping pressure through the courts or pitching up, trying to seize assets, or trying to appoint a receiver, or trying to appoint a liquidator, there are formal structuring solutions which I'm talking to in this webinar. I suppose we always move to the outcome on liquidation as a base position. So we look to see what is the position for creditors in a liquidation scenario where the business stops and there is a fallout from the liquidation. The assets being available for creditors in priority of their claims. That's our starting position and should be the starting position for any negotiation in an insolvency situation, because that really tells you what the worst case scenario is for creditors, and then you can work upwards from there and hopefully improve the situation with perhaps introduction of new money, some kind of restructuring of contracts, coupled with a write-off of debt to give a better outcome to creditors than in a liquidation scenario. I suppose a big question, and Dara certainly would have put the point of fundraising to drive a business forward. I suppose there is a cutoff point where bringing in new funds for working capital, bringing in new funds to drive the business forward, bringing in new funds to address legacy creditor liabilities makes sense or doesn't make sense. It might be that new funds coming in are good monies after bad, and that the legacy problems are so extreme that really you're throwing money into a black hole, and that a settlement of the creditor situation or a renegotiation of contracts going forward is required before new money comes in. Okay, so if you like, new money into the top of the balance sheet coupled with a reduction in monies owed to creditors on the bottom of the balance sheet. Okay, and why would you do that? Well, you would only do that if there was a future viability of the business going forward. You would only put new money in to a situation that had been reconfigured if there was a reasonable prospect of survival of the business going forward. And I use those words carefully because they're enshrined in legislation, reasonable prospect of survival. If there is a business that has a bright future and employs individuals, it is worth protecting, but may be captured in a balance sheet that needs some kind of restructuring, some kind of a surgery to allow the business wrapped in those problems to continue on into the future. I spoke about liquidation being the base case scenario. And why is that? Well, it's because some creditors are more equal than other creditors in a liquidation scenario. And enshrined in legislation is the priority of claims in a liquidation of various creditors. So I've given you a high level waterfall, if you like, of creditors on the left-hand side of the page. Okay. Top of the list in terms of getting paid first is a secured creditor. So that's a bit like a mortgage. In a company, the fixed charge mortgage is registered within a certain time period in the CRO. So it is there for all to see. Generally, these are banks that have secured charges over assets of the company. Often those assets are fixed in nature, like property. Similarly, but not quite a secured creditor, are leasing creditors. They actually own the asset, so they're even more advanced than a secured creditor in terms of having a claim in a liquidation. They can actually take the relevant asset because they own it. Likewise, secured creditors can appoint a receiver over a particular asset, and at that point, the asset vests in the receiver on behalf of the creditor. So they effectively own the asset at that stage and can sell it. So secured creditor, top of the list. After that, then come costs arising in a winding up. So often on a statement of affairs of a company in liquidation, you might see some assets, but those assets can quite quickly be eaten up by the winding up costs, which rank ahead of other creditors. Okay. Of course, one would say it's necessary for legals and professionals to actually do the work of winding up the company. Monies cannot be available in priority to all creditors before costs, because there is necessary work to be done. After the costs arising in the liquidation come revenue, rates, and employees. They are the preferential creditors. There is a super preferential creditor class, which relates to employee PRSI that's deducted. It's often relatively small in the overall context, but that super preferential creditor ranks ahead of the other preferential creditors, which are revenue, commercial rates, and employees. Revenue have a 12-month period for preferential status, and there are various periods like 4 months for employees, and the Department of Social Protection, which have an indemnity fund, which takes the place of creditors in a liquidation scenario. Rates, commercial rates from the council similarly has a 12-month period, and I'll talk to some of these creditors separately. There's some nuances affecting them also. After the preferential creditors, the banks come back in again under what's called a debenture or a floating charge. It's not always the case that the charge is registered against companies, but if there's something like an overdraft in the company, often the bank will take a debenture or a floating charge over the assets of the company. Okay, so that, for instance, is cash, stock, debtors that are not subject to invoice discounting, and other movable assets. Okay, and I draw the distinction there versus fixed assets, which are the likes of land and buildings and subject to secured charge or fixed charges from a secured creditor, like a mortgage. So the debenture really mops up any available realization of assets after the preferential creditors have got paid. Okay, so you can often see that in a severely insolvent company, really there might be something for the preferential creditors. They might get half or 20% of what they're owed, but perhaps then zero goes down to the floating charge creditor after that. Unsecured creditors really sit at the bottom of the creditor pile after floating charge creditors, after the bank's debenture, and these can comprise suppliers, those who are unable to have a lien or some kind of a retention of title over assets, and really are just waiting there at the bottom of the pile if there is any outcome for them, which is usually very unlikely certainly in a liquidation scenario. Okay, and of course shareholders will get nothing if there's an insolvent scenario. Their value of their share capital is completely wiped out. So if everybody understands what the situation is in a cessation of trade and a liquidation, if everybody understands how the assets in a liquidation are going to be dealt out to the creditors, then it's much easier to have a conversation. For instance, with unsecured creditors, the answer is, well, you're going to get nothing in a liquidation, so do you want to play ball? We'll try to agree a write down, we'll try to agree some kind of restructuring of contracts, and we'll introduce new monies to make sure that things are better off than in a liquidation. And the same applies for all sets of creditors. Some particular treatment of creditors that are interesting, and we have to bear in mind the situation, particularly around the various sectors impacted by COVID-19 here, and I'm thinking hospitality, retail, travel, and cultural businesses in particular. So let's take retail and hospitality. Well, in many cases there is a landlord, because there is a building. Okay, there is a lease in place. Okay, in many cases there is a bank that has provided an overdraft or has provided a term facility or a mortgage over property, and banks tend to be secured in nature. The landlord tends to have ownership of or does have ownership of the property, and has a lease that governs the relationship there with the company. I mentioned leasing as a form of finance. I suppose the difference with leasing is the lessors own the assets, so they can take back the assets in a liquidation scenario, which is effectively 100% payback up to the value of the assets, any residual then becoming unsecured creditors. I mentioned unsecured creditors often have retention of title if they have supplied products, and part of their terms of business might be, and at the bottom of their invoice might indicate that they have retention of title over goods that have not been paid for. I mentioned employees are elevated to a very special status, not just as preferential creditors, but also the government has an insolvency and a redundancy fund there, which indemnifies employees and pays out to them in instances where there are arrears of wages, holiday pay, non-payment of statutory minimum notice on a cessation of trade, and redundancy. Okay, the department then takes the place of the employees in a liquidation. So effectively, there is an insurance there for employees. I spoke about revenue, and Vic spoke about warehouse debt. Interestingly, what we're seeing at the moment is and prior to the pandemic, was that because revenue had preferential status and because of their very active nature in interventions, is that often revenue were prioritized ahead of other creditors. They had a preferential status. What we have now is revenue warehousing, where the opposite has happened, and we've very significant liabilities owed to revenue, whereas before they might have comprised a very small part of the creditor mix. So this is a really interesting outcome of COVID-19, directly relating to the warehousing piece. And now revenue, in many cases, are a very, very significant creditor in insolvency. That, coupled with their preferential status, makes them a more difficult creditor to try to deal with in an insolvency scenario, and we'll talk further to that later. And I spoke about rates, rates attached to a building. So it's not dissimilar to the leasing scenario, where rates carry over to a sale of the property and must be discharged in full from the property, notwithstanding the preferential nature of the liability. I want to touch very briefly on examinership. I spoke about an injection of investment coming into the top half of the balance sheet for working capital, and I spoke about a renegotiation of contracts and a write-off of creditors at the bottom half of the balance sheet. So the way you have a balance sheet in deficit, you're coming to a balance sheet that is break even or has some equity after a process. That can be done through the courts and is what's called the examinership process, that now extends to a 150-day time period for dealing with that write-off of debts and new investment coming in, and is conducted by an examiner. The reasons why: legacy issues, onerous contracts, that broken balance sheet we spoke about, trying to repudiate a lease or force a landlord to renegotiate new terms of leases. And the main purpose of examinership is to protect business and employment. I spoke about that reasonable prospect of survival. There is no point undertaking examinership unless there is a strong, viable business, and that needs to be proved to the judge. It needs to be proved to the judge that there's ability to attract investment, new money into the company, subject to that write-off of debtors and renegotiation of contracts. There needs to be an independent expert's report provided to the court underlining the reasonable prospects of survival of the business, and positive cash flows are part of that. I suppose the biggest criticism of examinership is it is a court process, so costs are relatively high. You're talking six figures, and therefore a more sizable business. And while we do have an examinership light process brought in 2014, which allows smaller companies access the circuit courts, again, you have the various counsel, solicitors, two sets of accountants, and the process is not dissimilar. So the costs can be quite high, albeit examinership can be very effective, particularly if there is significant new money available to be introduced to pay costs and to carry through the working capital going forward. I wanted to touch on the SCARP process, the rescue process that has come into legislation on 7th of December 2021. The idea of SCARP here is to be a non-court process and therefore to reduce costs versus an examinership. Not dissimilar to other insolvency processes, statement of affairs with that waterfall format of creditors is required to be prepared by company directors. A process advisor who's an insolvency practitioner is appointed and will report on survival prospects and whether it's a good candidate. Process advisor will be appointed. Again, payments to creditors will stop, and the process advisor then reaches out to creditors to prepare a rescue plan. Okay. Meetings of members and creditors are held between day 42 and day 49, which is voting on the plan, where 60% in number and 50% in value of one class of creditors is needed. Now, that's all going well if there is no opt-out on the process by revenue, and if proxies are returned in favor or ignored. However, if there is an objection to court by the creditor, it must be on the basis that they are unfairly prejudiced. So not just that they don't like being written down, but that they are unfairly prejudiced by the process. And there's a short 21-day period to apply to the court to do that. And likewise, if there is that objection, the process advisor has that period to apply to court for confirmation. So it's smaller businesses, turnover up to 12 million euro, balance sheet up to 6 million euro, no more than 50 employees, has to be insolvent. But again, that reasonable prospect of survival. Is there a good business going forward, trapped in a bad balance sheet? We talked about costs if it can be kept out of court. In theory, court involvement is not required. There is an ability to repudiate landlord leases, again through the court. And there is an ability for the court to stay creditor action if, for instance, a receiver or a liquidator is due to be appointed by a creditor. It is possible for the process advisor to apply to court for a creditor stay. This is very new legislation. Is yet to see what the response from revenue will be on their ability to opt out of the process, and yet to be properly tested in the courts. So watch that space. Finally, I just wanted to touch on personal insolvency. So we spoke a lot about corporates. In 2014, new legislation came in dealing with debt relief notice, wipes out very small debts. But more particularly the debt settlement arrangement, which can be tailored to sole traders, where a personal insolvency practitioner is appointed and deals directly with creditors, perhaps over a 5-year period where the individual continues to trade or continues to receive income and makes a payment every month to creditors, or from having a balloon payment made to creditors perhaps over 2 weeks of new money from outside the debtor's estate that can deal with the creditor situation. Again, these are formal arrangements and tailored to non-corporate debtors. So there are solutions in place for people who have not availed of limited liability through a company and have been trading personally. So look, I think we're just coming up on time there. We probably have a bit of time for questions there. Valerie, I'm not sure, are you able to see in the chat function whether there are any questions there, or whether
we don't have any questions there, Angus.
Okay, well look, we brought it right up to time. In fact, we've gone a little bit over. So I want to thank everybody today for dialing into this call on behalf of myself, Dara Kelly and Vic Angley. Thank you very much. We've certainly enjoyed the presentation, and we look forward to hearing from you directly. If you didn't want to ask questions today, please free to contact us directly. We will circulate the slides after this video webinar.